We're back to bank earnings week, with BMO the second name to report their first quarter financial results this week among Canada's big six banks. And while investors had a particular disdain for Scotiabank's earnings, they took a liking to BMO's results, with the equity closing out the day up nearly 5 percentage points following the release of the results. So, what drove the run? Let's dive in. Okay, so before we get into it, I have to say that Bank of Montreal is one of those weird companies that doesn't work on a fiscal versus calendar year. So they just completed the first quarter of 2025. All right. So the Bank of Montreal saw top line revenue jump by nearly 21% in the first quarter on a year-over-year basis, climbing from 7.7 billion to 9.3. Net interest income grew by 14% on a year-over-year basis, moving from 4.7 billion in Q1 of 2024 to 5.4 billion in the first quarter of this year. Non-interest income, meanwhile, improved by 31%, jumping from 3 billion to 3.9 on a year-over-year basis. Analyst consensus estimates, meanwhile, had called for top-line revenue of $8.6 billion, leading to a big beat for the Big Six bank. Net income improved to $2.1 billion, or $2.83 per share, which was a 66% improvement over the $1.3 billion, or $1.73 per share recorded in the year-ago period. On an adjusted basis, net income grew to $2.3 billion, or $3.04 a share, as compared to $1.9 billion, or $2.56 per share in the first quarter of 2024. Oddly, one of the largest adjustments during the first quarter was a $70 million adjustment related to accounting policies for employee vacations. Consensus estimates had called for earnings per share of $2.44 on an adjusted basis, with the quarterly performance leading to the bank hitting a new 52-week high on the day of the announcement. BMO ended the quarter with a return on equity of 10.6%, which improved from 7.2% last year. On an adjusted basis, return on equity grew from 10.6 to 11.3%. The common equity tier 1 ratio, meanwhile, grew from 2.8% to 13.6. The company closed the quarter out by announcing a dividend of $1.59 a share, which was an increase of 5% on a year-over-year basis, but flat on a quarter-over-quarter basis. The figure results in an annual dividend of $6.36 per share. BMO also repurchased 1.2 million shares over the course of the quarter. Let's dive into the segmented results a bit here. In personal and commercial, which is further broken down into Canadian and US based, net income totaled $1.5 billion, which came in flat on an annual basis. The Canadian segment actually saw net income decline from $921 million to $894 on a year-over-year basis, while the US operating segment saw net income improve from $560 million to $580, offsetting the decline within the Canadian operations. On an adjusted basis, the operating group saw net income decline to $1.5 billion from 1.6. These figures basically being flat within the segment are attributed to higher net interest income that was more than offset by higher expenses and provisions for credit losses. While personal and commercial was flat year on year, BMO's wealth management division saw net income improve 54%, moving from $240 million to $369. On an adjusted basis, the segment saw net income move from $241 million to $371. This increase was a result of strong global markets and an improvement in net sales. BMO Capital Markets also saw large gains on a year-over-year basis, with net income increasing 49%, moving from $393 million to $587. Adjusted net income grew to $591 million from $408 last year. The largest contributor to net income on a segmented basis, however, was corporate services, which saw last year's net income loss of $822 million shrink to $292 million. The improvement was far less dramatic on an adjusted basis, with the operating unit seeing its adjusted net loss improve from a loss of $316 million to a loss of $220. The improvement within the unit was largely a result of a large accounting loss taken a year ago related to the sale of a portfolio of recreational vehicle loans. All right, the part that everyone has been waiting for, which we commonly refer to as loss porn, also known as credit losses. Provisions for credit losses increased substantially in the first quarter of 2025, jumping 61% from $627 million last year to $1 billion in the current quarter. The ratio of PCL to average net loans, meanwhile, rose from 0.38 to 0.58. These provisions were largely contained to the personal and commercial operating unit, which saw total provisions for credit losses jump from $585 million last year to $956 million in Q1 of 2025. Total PCL to average net loans rose from a ratio of 0.45 to 0.69. On a segmented basis, Canadian P&C increased 84% from $295 million to $542 million. U.S. P&C increased less dramatically, rising 43% from $290 million to $414 million. Provisions were driven higher as a result of higher provisions in unsecured consumer lending, and as a result of the impact of the uncertain economic environment. Gross impaired loans, meanwhile, rose from $4.3 billion to $7 billion, with gross impaired loans to gross loans and acceptances rising from 0.65% to 1% year over year. As for the bank's loan book, residential mortgages aren't looking too hot. 7.7% of outstanding mortgages still have amortization periods in excess of 35 years, while the number of mortgages with amortizations in excess of 30 years is still over 10%. All right, so let's wrap it up. Despite provisions for credit losses rising and the residential mortgage book still needing plenty of improvement, BMO had a strong first quarter. That's evidenced by the 52-week high the stock made this week after posting the results. But I mean, when you operate an oligopoly, it's pretty tough for earnings to even be actually bad. Canadians basically get to choose between one of 6 banks to do their everyday banking at. And in that environment, how do banks possibly lose? All right, guys, we are in the thick of earnings season. If you have additional thoughts or areas you want us to cover on these banks, please let us know in the comment section. Also, if you made it this far into the video, it tells me that you are doing your homework on some pretty serious stocks, so I congratulate you for that. All right, everybody, thank you for watching. I'll see you tomorrow.